We have two primary statements, the balance sheet and the income statement, as well as the notes to the accounts.
So, isn't that enough?
Let's take a closer look. What can we use the balance sheet for? The balance sheet shows the company's assets and the sources of funds that financed these assets. What can we use the income statement for? The income statement, on the other hand, records the revenues and expenses that have been invoiced. It also includes estimates, depreciation for example, enabling us to determine the net income for the period.
So, we have everything then?
No, not at all, I'm afraid. We are missing the impact of all these transactions on the company's cash position. If we want to understand how the company is funded, how much it has invested, its cash position, and movements in this cash position, the balance sheet and the income statement just don't provide enough information. This is why the funds flow statement is useful. We can use it to analyze the company's cash position and the reasons for movements in this cash position.
If I start with my profit, I should be able to understand the changes in my cash position.
The funds flow statement doesn't seem to be published very often in France, so it isn't mandatory. That's correct. We have seen that this document is important, but it isn't mandatory in France. When we talk about the annual financial statements, this doesn't include the funds flow statement. The French Commercial Code and the Plan Comptable Général do not require companies to publish this essential document. It is merely recommended. Note, however, that it is mandatory for companies that exceed certain thresholds in terms of headcount and turnover, as well as for publicly traded companies. Let's take a closer look at the funds flow statement. The funds flow statement shows all of the transactions or flows that have affected the company's cash position in the financial period. It seems that the words cash and flow are inseparable.
But some transactions have no immediate impact on the company's cash position.
We will see how this is possible in the following example. Imagine that you purchase a consignment of goods from one of your suppliers with payment terms of 30 days. This transaction will be recognized in your income statement when you receive the invoice. The income statement will show the amount invoiced, not the amount paid. The impact on your cash position, the cash outflow, will only occur when you pay your supplier, as the supplier has given you credit terms. This cash outflow will be shown in the funds flow statement. These customer credit, supplier credit payment terms are retention points that delay the impact on the company's cash position. These payment terms are an essential component of what is known as the working capital requirement. The funds flow statement will show the change in this working capital requirement. This working capital requirement is essential for analyzing a company's cash position. eBiz City is a company whose business is divided into 3 activities: selling electric bikes, trading parts and accessories, and renting out electric bikes for short periods. The company's director asks you to prepare a flow statement to explain the changes in her cash flow. More precisely, she wants you to present the 2 types of flow statement from the PCG and IAS 7 for the last 2 financial years, so that she can choose for the last financial year N. You have the following information to help you with your task. The balance sheets for years N and N-1 reclassified into working capital requirement, and cash position. The income statements for years N and N-1. You also have the following additional information, such as dividends paid, the increase in long-term debt, loans repaid, and investments. Let's start by preparing the PCG funds flow statement. We will do this in successive steps. The first step is to determine the operating cash flow, the OCF. Use the indirect method to calculate the OCF for year N.
Remember that? Using the indirect method and the data from the income statement, we can calculate OCF by starting with net income and adding on all the non-cash items. This gives 344.32 plus 9.38 plus 8.3 minus 12.15 equals 349.85.